do believe we're just at the beginning of the tokenization of all assets.
The 2026 deadline isn't a suggestion. It's a production rollout. So you're either positioned before the switch actually flips, or you're buying after institutions have already front-run the entire move. So why would the world's biggest banks invent a system just to burn it and go back to paper? Because Wall Street never moves without an exit strategy. This is the two-way bridge. Institutions don't just upload a stock to the internet, they keep the physical asset at the DTCC as a baseline. As for the digital token, it's just a high-speed vehicle for trading. Think of the token like a digital twin in a high-speed flight simulator. In the simulator, which is our blockchain, you can fly at Mach 3, you can pull 9 Gs, and trade positions instantly because there's no physical friction. But the flight was never fake. The simulator is hardwired to a real multi-million-dollar jet that just happens to be sitting in the hangar, just like the stocks are in the vault at 55 Water Street. When the digital mission is over, then you burn the simulation data. The digital jet just vanishes from the screen. But the real jet, like I said, it's still sitting in the hangar, ready to be handed back to the traditional pilot. Tokenization doesn't replace the jet. It just lets us fly at speeds that the physical world could never allow by using a digital twin. So you might be asking yourself, why even bother? And to understand that, you have to look at the trapped capital that's in today's system. Currently, clearinghouses act as a central counterparty, stepping between every buyer and seller to guarantee that if one side fails, then the trade still goes through. And in order to manage the risk, they require banks to park billions in margin and to guarantee funds. It's essentially just dead money that's just sitting there in a vault for days, just in case there happens to be an error or someone defaults. Now, on a different path, if that asset is in token form on the blockchain, it moves with atomic settlement. So in layman's terms, this means that the payment and the asset transfer are all happening simultaneously and instantly. And that eliminates that settlement gap where most of the risk is living today, meaning it can pay dividends every second instead of every quarter, or it could be used as collateral for a loan that you might be making at 3 a.m. on a Sunday night. It moves from being this static piece of paper to a living piece of code that exists every moment of every day. So here's what this means for the markets. Essentially, capital efficiency begins to explode. When BlackRock can move $2 billion in tokenized treasuries instantly, instead of having to wait 3 days for a settlement period, I guarantee you they're not doing this for fun. They're doing it because it unlocks billions in trapped capital that no longer needs to sit idle as a safety buffer. The World Economic Forum estimates $20 billion in annual savings, and that's just from deleting the manual record keeping and the paperwork that just bogs down the system. That's the entire profit margin for mid-tier investment banks.
The reality is that behind the scenes, there's a lot of plumbing that intermediaries and inefficiencies that people are not aware of it. So if you think about what tokenization is, it's essentially upgrading the ledger where capital markets run to a better ledger technology that is public, that is distributed, cryptographically secured, etc., which will improve how people transact with security.
Data from RWA.xyz shows that over 65% of all tokenized real-world assets are running on Ethereum rails right now.
Wall Street is going to innovate on the blockchain over the next 10 to 15 years. But we're talking about tokenized equities, tokenizing credit, real estate, reputation, and eventually intellectual property.
JP Morgan isn't waiting for adoption. They're actually forcing it. Their Connexus network, like I said, is already moving $2 billion every single day on the chain. They aren't trying blockchain. They're using it to run the bank's global treasury to unlock the trapped liquidity that we've already talked about. Even corporate treasuries are betting their entire future on this type of backbone. Bitmine is now the largest fresh money buyer of Ethereum in the entire world, with a goal of owning 5% of the total supply. They are adding Ethereum to their balance sheet almost every single day. But here's the warning that everyone needs to hear. Yes, Ethereum is the backbone, but it's not a sure bet. We happen to be in an era of infrastructure wars, where institutions want the speed of the code, but the control of the entire vault. JP Morgan built Connexus on a permissioned version of Ethereum. They want the efficiency without the volatility. And then there's Goldman Sachs, which is spinning out their own platform of GSDApp because they want their own rails. They don't want to rely on someone else. This happens to be the battle for the next 50 years of financial infrastructure. Retail investors like us are betting on on public protocols, while institutions are building walled gardens. You need to understand which side is going to win before you actually allocate a ton of capital. So like I said, if the world's largest bank is moving $2 billion a day and the largest Ethereum treasury is cornering 5% of the supply, then how exactly do we play this? Here's the reality. Institutions had roughly 6 months of a head start on this type of trade, and the SEC's no action letter just dropped on December 11th, 2025. JP Morgan started to build out Connexus in 2020. BlackRock, they launched BUIDL in March of 2024. By the time that retail investors begin to hear about tokenization on the mainstream financial media, the easy money's already going to be gone. The deadline that is coming up in the second half of 2026, that happens to be when this goes from an institutional beta test to a production rollout for everyone. And that's our window. So how am I going to position my capital for the 2026 deadline? I'm leaning towards a 70-20-10 allocation. I'd put 70% in the banks that control the infrastructure, 20% into the pure play toll booth, and 10% into the speculative protocol bet. This happens to be more in line with my asymmetrical investment approach that you've probably seen and heard in my other videos. That 70% is the institutional moat. JP Morgan is moving $2 billion every single day through Connexus already. Goldman Sachs is spinning out GSDApp as a standalone entity, inviting other banks to trade on their rails, turning themselves into a software and fees business. Supporting plays are NASDAQ, which is selling tokenization software to other exchanges, and the custodians, BNY Mellon and State Street, are building the digital vault connections. To me, these are not moonshots. These are more safe bets because they're infrastructure owners that are capturing fees without a lot of protocol risk. Moving on to the 20%, think Securitize, ticker SECZ, expected to list on the NASDAQ in the first half of 2026 at roughly $1.25 billion valuation. Now, here's what they do. Securitize is the infrastructure company that tokenizes real-world assets for all these other institutions. They're an SEC-registered broker-dealer, transfer agent, and fund administrator, meaning that they handle all the legal and the technical plumbing in order to put traditional assets on the blockchain. They happen to be BlackRock's infrastructure partner for the BUIDL fund, $2 billion in assets with $100 million in dividends paid out. They control 20% of the entire real-world asset tokenization market. BlackRock, ARK, and Morgan Stanley are rolling 100% of their equity into the public company. No one is selling at IPO. If tokenization actually scales to the $2 trillion Standard Chartered projects by 2028, Securitize is the toll booth that's collecting fees on every single transaction. That happens to be the highest conviction pure play in this space. Now on to the last 10%, which is the speculative edge, where Ethereum hosts roughly 65% of the tokenized assets. And true to form for Tom Lee, he is projecting extremely high numbers for Ethereum, where he's expecting it to hit between $7,000 and $9,000 in early 2026, which I think is completely bonkers, but then again, he's been right an awful lot. So we're just going to have to all wait and see. Which brings us to BitMine, which is a leveraged version of Ethereum. It's a corporate treasury buying and holding Ether, and they're targeting 5% of the total supply. Well, right now, they're sitting on $3 billion in unrealized losses with massive share dilution. In my opinion, this is for aggressive speculators that are betting on major growth in Ethereum. This 70-20-10 allocation really matches my conviction. Institutions control tokenization, not crypto-native protocols. To me, the banks are going to win either way. Then there's Securitize with an upcoming IPO, which is going to win when volume begins to scale. And Ethereum only wins if it becomes the dominant settlement layer.
First one's Intuitive Surgical. Ticker symbol is ISRG. The thing with Intuitive Surgical is they're the undisputed leader in robotic-assisted surgery. Even if investors aren't necessarily familiar with the idea of surgical robots, they may have heard of the Da Vinci system. That's Intuitive Surgical's proprietary system. It's considered the gold standard. It's being installed in many hospitals around the world. Here's what makes the story a compelling investment story. Intuitive Surgical operates on what is called a razor and blade model. So they sell the Da Vinci system into hospitals. Now, those are expensive capital purchases, but they're one-time purchases. So it's a nice hit to revenue, but it's a one-time event. How Intuitive Surgical makes the real money is that they have recurring revenue that comes from every single procedure. Every time a surgeon uses a Da Vinci system, Intuitive Surgical is selling the hospital the instruments, the accessories, they provide the service contracts. And then as procedure volumes increase, business increases for Intuitive Surgical and margins expand. That means profits expand. And that's something that investors love to hear.
Yeah, absolutely. It's why we've heard this
Yeah.
name before because they're really on the front end of surgical robotics. Absolutely. But let's look at the stock details a little bit. I think the last time we talked about this stock on the channel was almost a year ago, and we were expecting a lot of growth. And we have seen that in the stock. But recently, there has been a little bit of pullback or maybe wavering in the stock price.
Yeah, this has been one of those stocks. If you look at it over a long period of time, like the name is Medtronic, ticker symbol is MDT. This is another stock that many investors will be familiar with. The thing that we have to talk about with Medtronic is they're not a pure play in robotic assisted surgery. Medtronic is diversified across a lot of categories, such as cardiac devices, diabetes management, neuroscience, but they do have a product called their Hugo system that is the direct competitor to Intuitive's Da Vinci system. So Hugo is a modular, portable robotic surgery platform. It's designed to make robotic surgery a little bit more accessible and flexible. Da Vinci is a sort of a standalone, stand-in-place system. So Hugo is that idea of it's more modular. The challenge that Medtronic has is Intuitive has had a big lead. They're fairly well entrenched in here, but Medtronic is trying to kind of eat into that market. And they're a $100 billion company. They've got deep relationships with hospitals and regulatory expertise. So they can play the long game here. And that's where an opportunity may exist for investors.
Yeah, interesting. How is this one really different from Intuitive Surgical, or is their growth story going to be somewhat similar?
The big advantage and possibly differentiator between Medtronic and Intuitive Surgical is the diversification angle here. Hospitals that are already buying things like cardiac devices, neurostimulators, or diabetes technology from Medtronic, they may be more willing to go and try the Hugo system because of those existing relationships. And then Medtronic, on their end, they can bundle their services. So that may make Hugo more attractive from a total cost benefit standpoint for the hospitals. That would be the biggest way that they're different. Again, they're not a pure play on robotics, but that could work to their advantage in certain situations.
Yeah, and we're going to get into what that's meant for their stock price
Right.
and what analysts have to say too. But I do have a couple more follow-up questions on just the company's future too. I think it's kind of a question for Intuitive Surgical and this one because they're such similar types of robotics
Right.
in healthcare companies. Is there research and development happening with both of these companies? Could there be future products, future types of robotic surgeries that they're currently working on within these companies that could be big catalysts in the future for either of them?
My answer to that would be, of course. I think that's something that they're always going to have to keep an eye on is how to keep these systems adaptable to different scenarios. Now, there's some surgeries that they're probably going to have a harder time doing than others, but they've been adapting. So right now they're designed to do surgical assistance. In the future, who knows where these could go?
Yeah, that's a good question, and still a question, it seems. That's still a part of the future story.
Through the patient's femoral artery. And the benefit to the patient, obviously, instead of, without that sort of invasive surgery, is patients can recover in days and not months.
Okay, very interesting. And something maybe some viewers have had experience with before. Again, this is a leader in that field, already operating in many hospitals across the US. Curious to see what the growth trajectory could look like. Is there still a lot of room for growth in this area, or are they already being used in many of the heart surgeries already happening?
That's a great question, Bridget, and I'll answer it two ways. So the first part is, as you can understand, when Edwards Lifesciences first introduced this TAVR, the FDA only approved it for very high-risk patients. But now, as clinical data has come in, they now have expanded their label is, as you might say, for TAVR to intermediate risk and even now low risk patients. So that's been a massive expansion of their total addressable market for that signature product. Now we can imagine that again, as we have an aging population, and the cases of this aortic stenosis are increasing, this is a durable, sustainable business model for the company. But that leads to my second point. The company is actually investing in next generation valve platforms that are even easier to implant. They're more durable and they're suitable for even a different range of conditions. So we're seeing that the fact that they understand that they've got to expand beyond the niche that they're in, and they are doing that. So I think that's where investors are excited about the growth to come.
Yeah, absolutely. I think that future growth and
Yeah.
all of the development happening in robotics right now could play a huge role in healthcare companies like this that are working on innovations in robotics and
Yep.
in these kind of robot-assisted surgeries and even hardware like this. I don't know what you think, Chris, but I do also think that companies that are already solid, they already are funded, they've got the cash flow they need, are probably the ones that are going to have a better chance of getting to those developments faster than maybe a startup company that's just trying to do something like this from scratch. What are your thoughts on that?
I completely agree with that. And I think that's what makes companies like this more attractive, because even when you have some of the startup companies, it will be the companies like Intuitive Surgical or Medtronic or now Edwards Lifesciences that have that balance sheet and the bandwidth where they can maybe even absorb some of those companies, or they could partner with those companies to bring different technologies to market. So yeah.
Yeah, and a very good point with this one. Also, you can see in the chart and the analyst forecast for this one, it's just a solid company. We still have about 22% upside on the consensus. There are some really high estimates for this one, which I think is interesting to see. What do you think of the higher end estimates for this one?
Analysts are seeing a lot of the same things that we're talking about right now. Robotics is a hot area, healthcare is a hot area, and these companies are merging those two themes very well. You're talking about an aging demographic in the United States. You're going to be talking about more need for robotic surgeries, and then in the case of Edwards Lifesciences, you're talking about something where there's going to be more need for not only different types of heart procedures, but just heart procedures in general. So I think analysts, they're seeing that this is where the trend is going, and they're seeing that these stocks have much higher to run.
Yeah, I think that's what is making my decision for which one of these to add to Britain's buys a little harder, because I think Edwards has a lot of growth potential ahead. I like to see some of those more recent